Friends, thank you for being here today. I ask that you take a moment to set aside the distractions of the daily news cycle. Turn off the television, close the other tabs on your browser, and focus with me on a singular, critical data point that is currently flashing red in the global financial system. We are not here to discuss speculation, nor are we here to engage in the type of breathless hype that characterizes so much of the modern financial media. We are here to discuss a mathematical impossibility that is occurring right now before our eyes. As you look at your brokerage account, or perhaps check the ticker on a financial news network, you are likely seeing a spot price for silver hovering around $85 per ounce. In a vacuum, this is a robust number. However, we do not live in a vacuum. We live in a globalized, interconnected market, or at least we used to. The reality, which I must impart to you with the utmost seriousness, is that the price you see on your screen, that 85 figure generated by the COMEX in New York, has become a fiction. It is a ghost number. A legacy of a system that is rapidly losing its tether to the physical world. I say this because on the other side of the globe, in the Shanghai Gold Exchange and the Shanghai Futures Exchange, the actual price, the price at which physical metal is changing hands between willing buyers and sellers, just closed at 93.31 per ounce. This is not a clerical error. This is not a momentary glitch. This is a structural break in the global commodities market. We are witnessing a spread of over $8.31 between the Eastern price and the Western price. In the parlance of professional trading, this is known as an arbitrage opportunity. In a functioning, healthy market, such a gap would be closed within minutes, perhaps hours, by traders buying the cheap asset in New York and selling the expensive asset in Shanghai, pocketing the difference and neutralizing the spread. But that is not happening. The gap is not closing. It is widening. The arbitrage is dead. And the death of that arbitrage mechanism is the single most important signal for your portfolio in decades. It signifies that the bridge between the paper promises of Wall Street and the physical reality of the rest of the world has been incinerated. Today, I want to walk you through exactly why this is happening, why the smart money is quietly exiting the paper markets, and what this bifurcation of price means for the preservation of your wealth in the coming weeks. To understand the specific anatomy of this breakout, we need to analyze the data coming out of Shanghai. To understand the gravity of this situation, we must look dispassionately at the data emerging from China. As of the close of the afternoon session today, January 12, 2026, the trading activity in Shanghai exhibited characteristics that we typically associate with a currency crisis or a sovereign debt default, not a standard commodities trading day. The Shanghai Futures Exchange operates in two primary sessions, the morning, AM, and the afternoon, PM. During the AM session, silver was already trading at a significant premium, closing at $91.13 per ounce. This alone was a massive deviation from the U.S. spot price, signaling a strong, sustained demand for physical delivery. However, markets can be volatile, and a morning rally can often fade as profit takers step in. That is not what happened. When the PM session opened, the dynamic shifted from accumulation to what can only be described as a liquidity vacuum for physical metal. We witnessed overwhelming buying pressure that did not come from retail speculators or day traders. The volume and the nature of the orders suggest institutional actors, corporate procurement officers, strategic state-owned enterprises, and industrial giants sweeping the order book. They were not placing limit orders hoping for a pullback. They were hitting the ask, buying everything available at any price. By the close of the session, the price had ripped upward to 93.31. A move of over 2.0 in a single afternoon session for a major global commodity is statistically rare, a tail risk event. It indicates that the buyers were not motivated by price sensitivity. They were motivated by availability sensitivity. In other words, they were more terrified of not getting the metal than they were of overpaying for it. This brings us to the chasm. We must stop referring to this 8.31 difference as a premium or a spread. Those terms imply a temporary dislocation in a functioning system. What we are seeing is a market failure. The US market and the Chinese market have bifurcated. They are now two separate liquidity pools that have lost their relationship to one another. We have been tracking this data since the implementation of China's new export licensing system on January 1st. 2 weeks ago, the spread was $5. Last week, it widened to $7. Today, it broke $8. This trajectory is exponential, not linear. It tells us that Chinese buyers are effectively front-running the inevitable collapse of the Western paper market. They are willing to pay $93 today because they have calculated that the true value of the metal is significantly higher, and they know that the Western price of $85 is an illusion maintained only by paper leverage. This leads us directly to the mechanics of market failure and the question of why arbitrage is dead. For those of you who have spent your careers in business, engineering, or finance, the concept of arbitrage is intuitive. It is the mechanism that keeps global prices efficient. If gold is cheaper in London than in New York, you buy in London and ship to New York until the prices align. It is the law of one price. So the trillion-dollar question we must answer is, why aren't the global banks, the hedge funds, and the commodity trading houses buying silver at 85 hot bars in New York and selling it at 93 in Shanghai? There is an $8 risk-free profit sitting on the table for every single ounce. In a 1,000-ounce bar, that is $8,000 of free money. Why is no one taking it? The answer is as simple as it is terrifying. They cannot source the metal. Arbitrage requires two distinct capabilities: price divergence and physical availability. We have the divergence, but the availability has evaporated. When large entities attempt to stand for delivery on the COMEX, Commodity Exchange, in New York, or when they try to source 1,000-ounce commercial bars from wholesalers to ship to China, they are hitting a brick wall. The registered inventory at the COMEX, that is, the silver that is actually available for delivery against futures contracts, has plummeted to approximately 30 million ounces. To the layperson, 30 million ounces sounds like a vast quantity. However, we must view this number in the context of open interest. Open interest refers to the total number of paper contracts outstanding. Currently, the claims on silver vastly outnumber the available ounces. The leverage ratio is astronomical. The smart money saw this liquidity crunch developing months ago. They have already drained the eligible vaults. The metal that remains is largely encumbered, leased out, or owned by entities that refuse to sell at these artificially low prices. Furthermore, the logistical bridge has been destroyed by geopolitical maneuvering. The Chinese government's implementation of strict export licensing has created a one-way valve. Silver can flow into China, but it cannot flow out. Even if a trader could somehow secure silver in Shanghai, they couldn't ship it back to the West to settle a trade. But the primary issue is the flow from west to east. Banks cannot buy what does not exist. They cannot ship what they cannot possess. Therefore, the two markets are floating free. The Shanghai price represents the cost of physical reality, scarcity, industrial necessity, and monetary panic. The New York price represents the cost of a paper promise, a futures contract that may or may not be honored with metal. The fact that the paper price is lagging by 8 is simply a measure of the market's current delusion. But as with all delusions, this one will shatter when it collides with hard reality. I want to pause here and ask you a question. Which price do you trust? Do you trust the $85 computer-generated price in New York or the $93 physical price in Shanghai? Let me know in the comments below. Paper or physical? I want to see where this community stands. Now, let Yes examine the domestic impact and determine the real cost of silver right here in America. You might be asking, if I am an American investor, why does the price in Shanghai matter to me? I buy my silver here. This is a valid question, but it stems from a misunderstanding of how global pricing eventually resolves. China is the leading indicator. It is the canary in the coal mine. The canary has died. The US market is currently in a state of suspended animation, but the localized data suggests that the catch-up event is imminent. While the screen price says $85, I have spent the last 24 hours communicating with executives at the largest bullion dealers in the United States. These are the firms that supply the retail market, the private wealth offices, and the family trusts. The consensus among them is unanimous and chilling. Their words were precise. Nobody has any silver. In the physical market, we measure stress through premiums, the amount a buyer must pay over the spot price to take immediate possession of the asset. In a normal market, premiums on silver rounds or bars might be $2 or $3. Last week, they rose to $5. Today, following the Shanghai breakout, premiums exploded to $8 and $9 over spot. However, the future guidance from these dealers is even more alarming. They are projecting that within days, premiums on standard silver rounds could reach $20 to $30 per ounce. Let's do the math on that. If the spot price remains at $85, but the premium is $30, the real price, the price you write the check for, is $115. This means the US physical market is effectively already trading near the Shanghai price, just disguised by high premiums. The supply chain has completely fractured. Private mints, which strike the coins and bars for investors, are reporting 8-week delays. They cannot source the silver grain, the raw material, from refineries because the refineries are bypassing them. Why are the refineries bypassing the mints? Because they are prioritizing strategic industrial partners. Companies like Tesla, Apple, Samsung, and the massive solar panel manufacturers have rigid contracts with refineries. They need silver not as a store of value, but as a critical industrial component. Without silver, they cannot produce cars, phones, or energy. They are absorbing 100% of the available wholesale supply, leaving nothing for the investment-grade mints. This leaves the individual investor in a precarious position. If you place an order today, you are essentially gambling. You are locking in a price and hoping that the mint can source the metal and deliver it in 2 months. But what happens if in those 2 weeks, the price resets to $150? What happens if the mint declares force majeure and refunds your depreciating currency because they simply cannot find the silver? Buying silver today involves an 8-week delay and substantial counterparty risk. The inventory that dealers claim to have is often inbound, not in hand. We are witnessing a classic run on the bank, but the bank is the global silver supply and the vaults are empty. And this is where I need your help. We are building a map of supply shortages across the country. If you have visited your local coin shop recently, tell me in the comments, are the shelves empty? Are the premiums rising? Your boots on the ground reports are more valuable than any government statistic. To fully grasp why this is happening now, we must zoom out to the macro context and the liquidity black hole forming in the global economy. To understand why this is happening now, we must zoom out from the specific mechanics of the silver market and look at the broader macroeconomic landscape. The vertical move in silver is not occurring in isolation. It is happening in tandem with a historic breakout in gold, which has breached $4,600 per ounce, and a simultaneous collapse in the credibility of sovereign debt. For the past 40 years, the American retirement model, and indeed the global financial system, has been built on the risk-free rate provided by U.S. Treasury bonds. The assumption was that treasuries were the safest asset in the world, and all other assets, stocks, real estate, corporate bonds, were priced relative to them. That model is breaking. We are currently seeing a phenomenon that terrorizes central bankers, the correlation of all assets moving to one. However, specifically, we are seeing a rejection of government debt in favor of hard assets. Investors are looking at a U.S. Treasury bond yielding 4% or 5%, and realizing that the real rate of inflation and the rate of currency debasement is significantly higher. Holding the bond guarantees a loss of purchasing power. Conversely, gold and silver yield 0% in interest, but they have appreciated 30% and 170% respectively in terms of purchasing power. Capital flows where it is treated best. We are witnessing a massive rotation of capital out of the risk-free or paper world and into the counterparty-free physical world. This creates a liquidity black hole. As yields on treasuries rise due to selling, borrowing costs for the government and corporations skyrocket. This slows the economy. Usually, in a slowing economy, investors sell commodities and buy bonds. But this time, they are selling bonds and stocks to buy commodities. This is the hallmark of a stagflationary depression, the economic nightmare of the 1970s, but with debt levels that are mathematically unpayable. We must also address the elephant in the room, the Federal Reserve. The news breaking regarding the criminal probe into Federal Reserve Chairman Jerome Powell is, in my view, a symptom of a much deeper institutional rot. Whether the investigation yields results is almost irrelevant. The damage is reputational. The market operates on confidence. When the chairman of the world's most important central bank is under investigation for conflicts of interest precisely when the bond market is melting down, confidence evaporates. The Fed is now caught in the ultimate trap, one that has been building since the creation of the Federal Reserve in 1913. They have only two choices, and both lead to a repricing of silver. The first option is the inflationary pivot, where they attempt to save the bond market and the banking system by printing trillions of dollars through yield curve control. This path creates hyperinflation, a scenario where silver does not stop at $100 but climbs to $200, $300 or higher, purely as a function of the dollar losing value. The second option is the deflationary crash, where they try to protect the dollar by keeping rates high and refusing to print. This triggers a massive depression, forcing defaults across real estate and corporate debt. In this scenario, the financial system freezes, counterparty trust vanishes, and capital flees to the only assets that have no liability attached, gold and silver. This is why I consider silver the most asymmetric trade in financial history. Whether we face fire, inflation, or ice, deflation, the destination for capital is the same. The Fed has lost control of the narrative and the market is voting with its feet. Let me ask you directly. Do you have any confidence left in Jerome Powell and the Federal Reserve to fix this mess without destroying the dollar? Type yes or no in the comments. I think I know what the answer will be, but let's put it on the record. But friends, to truly understand the urgency, we must look beyond the financial plumbing and look at the geopolitical chessboard and the industrial reality, what I call the industrial vice. While the Federal Reserve plays its political games, there is a much more pragmatic, physical war being waged for control of the resources that will define the next century. This is where the story shifts from money printing to national security. And this is the part of the equation that most financial advisors simply do not understand because they are trained to look at charts, not supply chains. You see, for the last 50 years, the West has been content to financialize the world. We built derivatives, we built complex debt instruments, and we built a service economy. Meanwhile, the East, specifically China, but increasingly the entire BRICS bloc, has been industrializing the world. They have focused on the tangible: ports, bridges, factories, and critically, the refinement of raw materials. Why is China willing to pay $93 for silver when the market price is $85? Is it just because they are hedging against the dollar? No, it is because they need the silver to maintain their dominance in the energy sector. Let's look at the solar industry. This is not about saving the planet or climate politics. This is about hard industrial data. The solar industry is currently undergoing a massive technological shift from P-type cells to N-type cells, specifically TOPCon and HJT technologies. I won't bore you with the engineering minutiae, but here's the only fact that matters to your wallet. N-type solar cells require 50% to 80% more silver per watt than the old technology. China manufactures over 80% of the world's solar panels. They are the OPEC of green energy. If they run out of silver, their factories stop. Their energy dominance stalls. For Beijing, silver is not a speculative asset. It is a strategic industrial material, arguably more critical now than oil. They are sweeping the global market, not to trade it, but to consume it. Once that silver goes into a solar panel, it is effectively gone for 20 years. It is taken off the market. It is not sitting in a vault waiting to be resold. It is soldered onto a silicon wafer on a roof in the Gobi Desert. This creates inelastic demand. If the price of silver goes to $150, Apple cannot stop buying it for their iPhones. Tesla cannot stop buying it for their EVs. The solar fabricators cannot stop buying it. They must pay the price, whatever it is, because the cost of silver is still a small fraction of the total device cost, but the device cannot function without it. This is the industrial vice. The industrial users are squeezing the supply, and they have deeper pockets than any retail investor. And this industrial hunger collides directly with the derivatives time bomb, ticking inside the Western banking system. This is the part that keeps bank CEOs awake at night. For decades, bullion banks in London and New York have managed the price of silver through the fractional reserve model. They sell paper contracts representing silver they do not possess, assuming that only a tiny fraction of investors will ever ask for delivery. This is the naked short position. It works beautifully when the market is calm. It generates billions in fees. But what happens when the physical market breaks away, as we are seeing in Shanghai? As the price rises to $93, $100, $150, these banks are caught in a short squeeze of biblical proportions. Every dollar the price rises is a dollar of loss on their books. And we are not talking about small losses. We are talking about tens of billions of dollars in potential exposure. If they try to cover their shorts by buying physical metal, they drive the price even higher, exacerbating their own losses. It is a death spiral. This is why the arbitrage is dead. The banks cannot step in to close the gap because they are fighting for their own survival. They are trying to cap the price in New York to prevent a margin call that could bankrupt them. But they are fighting against the tide of Chinese industrial demand. It is a fight they cannot win. So when you see that spread widening, realize that it is the sound of the Western banking system's suppression mechanism failing. The spring has been held down for 40 years, and it is about to snap back with violence. Given this backdrop, let's conduct a strategic analysis of the dangerous divergence between paper promises and physical reality. Given this backdrop, we must discuss strategy. For those of you in the baby boomer generation, your primary objective is likely capital preservation, not reckless speculation. You cannot afford to lose 50% of your purchasing power in a currency reset. However, the strategies that worked 5 years ago, or even 6 months ago, are now fraught with danger. The most common question I receive is regarding ETFs, exchange-traded funds, specifically SLV, iShares Silver Trust. I must be very clear on this point. In a market dislocation, SLV is a trap. The SLV ETF is designed to track the price of silver, but it is not the same as owning silver. The metal backing the fund is held in vaults by custodians, primarily JP Morgan. We have no independent verification of how much of that silver is unencumbered. More importantly, if you read the prospectus of the SLV, you will find clauses related to market disruption events. These clauses effectively state that if the custodian cannot source the metal, or if the delivery mechanism fails, the fund has the right to settle your shares in cash. Imagine a scenario where silver goes to $200 per ounce because the dollar has collapsed. You hold SLV shares. You attempt to redeem or sell, but the fund declares a market disruption. They look at the last official closing price, perhaps the artificial 85 we see today, and they send you a check for that amount. You are paid out in the very currency that is becoming worthless, while the asset you thought you owned has appreciated beyond your reach. This is the definition of counterparty risk. In a crisis, paper contracts are settled in paper. Physical contracts are the only ones that matter. If you require liquidity and cannot hold physical metal, a far superior option is the Sprott Physical Silver Trust, PSLV. Unlike SLV, PSLV is a closed-end fund domiciled in Canada, with metal stored at the Royal Canadian Mint. It is fully allocated, meaning there is specific metal attached to the shares, and they offer a mechanism for physical redemption, though the minimums are high. It acts as a much safer bridge than the Wall Street-backed ETFs. However, the gold standard, pun intended, remains physical possession. Coins, bars, and rounds in your own safe or a private, non-bank vault in a jurisdiction you trust. As the adage goes, if you don't hold it, you don't own it. In an environment where arbitrage is dead and banks are failing to deliver, possession is 100% of the law. This brings us to the difficult psychology of buying at these levels, or what I call the logic of the escalator. Finally, I want to address the psychology of buying at these levels. I know many of you are value investors. You see a price of $93 or $100 after premiums, and your instinct is to wait. You think, I will wait for a pullback to $75. This is a dangerous mindset in a supply-driven squeeze. We are experiencing what I call the escalator effect. Consider the timeline. 2 years ago, the entry point was $20, yet you waited. 6 months ago, the entry point moved to $30, and you waited again. 2 weeks ago, it hit $75, and still you waited. Today, the all-in cost is near $94. If you wait for a dip next week, you may find the price is $115. Or worse, you may find that the price is technically lower, but there is zero inventory available to buy. A price of $50 is irrelevant if there is no metal for sale at $50. We are entering a period of scarcity. When a commodity runs out, the price creates a new floor at every step upwards. Paying $94 today is painful compared to $20, but it is a massive discount compared to the $150 or $200 price that is mathematically necessary to clear the market imbalance. Do not be the investor who watches the price hit $200 and says, I should have bought at $94. The regret of overpaying by $5 is temporary. The regret of missing the life raft entirely is permanent. Friends, this brings me to my conclusion. We are facing a Lehman moment for commodities. We are standing at a precipice. The events of January 12, 2026 will likely be looked back upon by financial historians as the Lehman Brothers moment for the global silver market. But instead of a bank collapsing from bad debt, we are seeing a market structure collapse from a lack of physical collateral. The Shanghai price of 93.31 is the smoking gun. It is the undeniable proof that the Western financial system creates fantasy prices that can no longer be sustained. The $8 gap is not just a spread, it is a countdown clock. The Fed cannot print silver, the COMEX cannot print silver, the mints cannot conjure silver out of thin air. The only resolution to this imbalance is for the US price to explode upward to meet the reality of the physical market. This will likely happen overnight. You will wake up one morning, perhaps a Tuesday after a long weekend, and the price will have gapped from 85 to 110. There will be no opportunity to buy the middle. The Western market is living in a fantasy. The Eastern market is living in reality. History has taught us, time and time again, that reality always wins. The window to convert your paper fiat currency into tangible store of value assets is closing. The premiums are rising, the delays are lengthening, and the supply is vanishing. I urge you to look at your portfolio. Look at your exposure to the dollar and the bond market, and ask yourself if you are prepared for the repricing that is already happening in Shanghai. Get your money out of the system that is breaking. Get your wealth into the assets that are real. If you found value in this analysis, please hit the like button to help spread this warning to others who are still asleep. And if you haven't subscribed yet, please do so. We need to stay connected as this crisis unfolds. Thank you for reading, and may you navigate these turbulent times with wisdom and prudence.